Welcome back to Talk Tickers. This is the deep dive for the buy-side mind. We're not here to read press releases. We're here to strip away the PR fluff and get straight into capital allocation. Today is Tuesday, January 27, 2026, and we are ripping through the tape on Northwest Bancshares, ticker NWBI.
Good to be here. And yeah, looking at the tape this morning, it feels like the market is holding its breath a little bit on this one.
It does. We're looking at the Q4 2025 earnings, and this is what I call a classic scale and stabilize quarter. Northwest just wrapped up this massive integration with Penns Woods. They called it a transformational year, and now they have to prove they can actually run the combined ship.
That is the perfect way to frame it. The honeymoon phase of the merger is, well, it's officially over, and now comes the marriage.
Right.
And if you look at the screen, the market is, let's call it, politely interested.
Politely interested is a generous way to put it. Let's just hit the price action right away. The stock opened around $12.65. That's up a tiny fraction, maybe 0.16%?
Barely a flicker.
It's barely moving. So why aren't we seeing a bigger pop on what on paper looks like a beat?
Well, that tells you everything, doesn't it? The market isn't popping champagne, but it isn't selling off either. It's a classic show me reaction.
Okay.
Investors see the execution mergers done, systems are converted, but they're waiting. They're waiting to see if the organic growth engine actually, turns over now that the M&A noise is gone.
Right. You can only cut costs from a merger for so long.
Exactly. Sooner or later, you have to actually sell something.
So our mission today is pretty clear. We're breaking down this first full quarter as a combined entity. We need to look at what I think is a massive opportunity in their deposit book, the CD cliff, which we'll get to.
Oh, yeah.
We get to talk about that one.
Yeah.
Ugly credit charge-off that everyone is whispering about.
The elephant in the room or the student housing complex in the room.
We'll get there. But let's start with the headline numbers. Give us the scorecard.
Yeah.
What did the street expect and what did they deliver?
All right. Headlines look solid. JAP earnings per share came in at 31 cents. But adjusted EPS, which is what the street really cares about, that landed at 33 cents.
So a 2-penny beat.
A 2-penny beat against a consensus of 31. Decent.
Decent in this environment. And the top line.
Revenue hit a record. About $180 million for the quarter. That beat consensus by over $6 million, or about 3.7%. And year over year, revenue is up nearly 20%.
Okay, so on the surface, those are all green arrows. Management's framing this as the successful end of the Penns Woods integration. They mentioned cost savings are ahead of schedule. They're expecting to hit 100% of those savings in Q1. Sounds like a victory lap.
It is impressive. I mean, usually bank integrations are messy. They drag on, systems fail.
Customers get angry.
Right. So getting to 100% savings ahead of schedule is a real feather in the cap for the CFO. And here's the nuance that explains the flat stock price. The market had largely priced this in.
You think the efficiency was already baked into the 1260 handle?
I do. The revenue beat looks great, but when you peel it back, a chunk of that is just purchase accounting and the balance sheet scaling we knew was coming.
It was mechanical.
It was mechanical. The market knew the merger would boost the top line. The question now is, where does the next dollar of growth come from?
Let's dig into where that profit is coming from. This brings us to the margin story. Net interest margin, or NIM, the lifeblood of a regional bank. It expanded to 3.69%, up 4 basis points.
In this environment, any margin expansion is like the holy grail.
Right.
Most banks are just trying to keep NIM flat.
So what drove it? Was it better lending or cheaper deposits?
It was mostly on the asset side, higher average loan yields. The loan book is yielding 5.65% now.
Yeah.
And purchase accounting accretion contributed about 4 basis points as well.
Hold on, let's slow down and explain that. Purchase accounting accretion, what does that actually mean for the cash flow?
Sure. It's a bit of an accounting quirk. When they bought Penns Woods, they'd had to mark all their loans to fair market value. Rates had gone up, so those old loans were worth less.
Bought at a discount.
Bought at a discount, exactly. So as those loans get paid down, that discount gets recognized as income over time. It gives a temporary boost to your reported margin.
So it looks like income, but it's really just realizing the discount you got when you bought the bank.
That's it. It's real money, don't get me wrong, but it burns off. So about half of that expansion was these accounting tailwinds, but the other half was genuine core improvement, which is what you want to see.
That distinction matters. And looking forward, management is guiding for low 370s for the full year of 2026.
Which implies stability, maybe a little more expansion. And that brings us to the most interesting part of this balance sheet right now.
The hidden gem, the certificate of deposit portfolio.
This is the critical piece on the liability side.
They said 43% of their entire CD portfolio matures in the first quarter of 2026. I mean, that's a massive chunk of funding rolling over right now.
It is huge. And look at the rate. It's maturing at a weighted average rate of 3.6%.
Okay, so help me understand the game theory here. Usually a maturity wall is terrifying for investors. Why is a maturity wall at 3.6% a good thing?
Because the script has flipped. In 2024, you were refinancing 3% debt into 5% debt. It crushed margins.
Right.
But now, in 2026, the market is assuming rate cuts. 2 more this year, maybe. The short end of the curve has already softened.
So Northwest has this huge opportunity to reprice almost half their CD book lower.
Exactly. Or at least not higher. Instead of renewing those CDs at 4.5% or 5%, which is what they would have done a year ago, they might roll them over at rates closer to where they are now.
That turns a headwind into a tailwind.
It does. While other banks are stuck with expensive funding they locked in at the peak, Northwest gets to reset the deck. It's what we call liability sensitivity working in your favor.
A natural hedge.
It's a very comfortable position to be in. It's a potential margin lever that I think the market might be underappreciating.
The Rust Belt repricing benefit.
It really is.
Okay, let's shift to integration and expenses. Penns Woods is fully digested. The efficiency ratio shows it, improved to 59.5%.
And getting under 60% for a bank this size is the target. It means you're spending 59.5 cents to make a dollar. That's good. It shows operating leverage.
They set 2026 expense guidance at $420 to $430 million. But there was a caveat about Q1 I want to flag.
Yeah, context is key here. Q1 always looks a little ugly on expenses for banks. You have FICA tax resets, 401k matches. It happens every year.
And every year, the algorithm bots see the jump and sell the stock.
Right. So if you see Q1 expenses spike in the next report, don't panic. Look at the full year run rate. The guidance suggests they can keep costs flat while revenue grows.
And that's the definition of positive operating leverage.
That's the math they're banking on.
But you can't just cut your way to greatness. Let's look at growth. Because they're not just sitting in rural Pennsylvania anymore.
No, they have a few interesting engines firing. The most notable is the loan mix.
C&I commercial and industrial loans grew 26% year over year. That is a big number.
It's huge, and it signals a change in identity. Historically, Northwest was a sleepy thrift. They wrote mortgages.
Safe, but low yield.
Exactly. C&I lending is financing businesses. That usually comes with a variable rate and a relationship that brings in deposits. You're becoming a real business bank.
And then there's the SBA business. I was surprised to see they're a top 50 originator in the U.S. now.
This is a smart strategic pivot. With SBA loans, you get optionality. You can keep the loan on your books for the high yield, or you can sell the guaranteed portion for an immediate cash fee.
So it's a dial they can turn. Need income now. Sell the loan.
Precisely. It diversifies their revenue stream away from just spread income, makes the earnings smoother.
They also talked about geographic expansion. They're pushing hard into Columbus, Ohio.
Columbus is the battleground. It's a growing market, unlike a lot of their legacy footprint. Columbus has demographics on its side.
And they're opening these hospitality-focused financial centers there. Is that just marketing fluff, or is there a real strategy?
It sounds gimmicky, but think about it. Nobody goes into a bank branch anymore to cash a check. You go for advice.
For your small business.
Right. If the branch looks like the DMV, nobody wants to be there. If it looks more like a lounge, maybe you capture that business owner. It's about differentiation.
Fair point. But the key takeaway from the strategy session wasn't the fancy lobbies. It was what they're not doing. CEO Lutorio said they are cooling on M&A.
Yeah, he was pretty explicit. 2026 is about organic execution, not buying another bank.
And shareholders should love hearing that. M&A is risky, it's expensive, it's distracting.
Absolutely. After a big meal like Penns Woods, you need to digest. Focusing on Columbus and the SBA vertical is the lower risk, higher return play for the next 12 months.
Okay, we have been pretty positive, but we have to address the red flag. We cannot ignore the credit situation.
The $19.2 million charge-off.
It's an ugly number for a single quarter, and it's on a single student housing loan.
Management's explanation was that this is a one-off. They said the loan is 10 years old, it's been in workout for years, and they finally just ripped the Band-Aid off.
And they said they have no other meaningful concentration in student housing. So Is this a cockroach theory situation, or do we believe them?
That's the million-dollar question. I mean, the metric that matters, annualized net charge-offs, hit 40 basis points for the quarter. That's elevated.
But for the full year.
For the full year, they landed at 25 basis points, which is at the bottom of their guidance range. So statistically, they're okay. But optically, it looks bad.
Investors hate surprises, especially in anything close to commercial real estate.
Exactly. Even if it is a cleanup quarter, a $19 million hit makes people wonder, well, what else is in that loan book from 10 years ago?
And the delinquencies, they ticked up.
Right, from 1.1% to 1.5%. Management blamed that on mortgages and a 31-day month calendar quirk.
The calendar made me do it.
Yeah, it sounds a little bit like the dog ate my homework.
Does that explanation hold any water?
It's a valid technical point in accounting, but frankly, when you combine a big charge-off with a spike in delinquencies, nobody wants to hear about calendar quirks. It puts a ceiling on the stock price.
So the market is saying, okay, you say it's a one-off, prove it next quarter.
Exactly. Credit is guilty until proven innocent.
Let's zoom out. We have the 2026 guidance, revenue 710 to 730 million, loan growth low to mid single digits.
It's realistic guidance. They're not promising the moon. It's steady.
So how do you play this? If you're looking at the regional bank sector, the KRE or the XLF, where does Northwest fit?
Well, regional banks are all fighting the deposit beta war. Northwest has a secret weapon for stability, their dividend streak.
125 consecutive quarters? That's over 30 years.
That puts them in the safety bucket. In a volatile market, you hold NWBI for that stable NIM and the dividend. It's not a growth rocket. It's ballast for the portfolio.
And the catalyst is the pivot from integration year to earnings power.
Right. If they hit the top end of that revenue guide, $730 million, and keep expenses flat at $420, the operating leverage is significant. That's where you get beats later in the year.
Okay, we've analyzed the past. We've looked at the guidance. Now for the fun part. It is time for the This Is Not Financial Advice segment.
My favorite part.
Remember, we are just voices in your headphones. Do your own diligence. But if you were pitching this today, what's the trade?
The trade is this. I call it the Rust Belt repricing arbitrage.
Ooh, catchy. Pitch me.
The setup is simple. Everyone is worried about falling rates hurting bank margins. The narrative is rates go down, banks make less money.
Standard thinking. The consensus view.
But Northwest has that 43% CD maturity cliff in Q1. They are an anomaly.
Okay.
So the outrageous trade is long NWBI and short an asset-sensitive peer.
Break that down. What's the short side look like?
You find a bank that has all floating rate loans and sticky deposits. A bank that gets crushed when rates fall because their income drops instantly, but their expenses stay high. You short them, and then you go long Northwest.
Why?
Because when rates get cut, Northwest's cost of funds is going to plummet faster than their loan yields because of that CD cliff. You're betting on margin expansion for Northwest despite rate cuts, while the rest of the sector sees compression.
That's a pretty sophisticated way to play the rate cycle.
Exactly. While other banks are trying to invent AI banking, Northwest is just going to let expensive CDs roll off the books and pocket the difference. It's the boring game, but it wins.
And the catalyst.
The Q1 2026 earnings report in April, that's when they reveal the new lower cost of deposits and the margin pops above 375. That's when the stock breaks out of this 1265 range.
I like it. Rust Belt repricing. You heard it here first.
Don't bet the farm on it. As we saw, there's always risk.
All right, let's wrap this up. Conclusion.
NWBI delivered a beat and raise quarter, but it was masked by that credit cleanup. The financials are solid, but the market is cautious.
The integration is done. The excuses are gone. They have the cost structure right. They have the systems right.
And 2026 is the year they have to prove organic growth. Can they actually win in Columbus? Can the SBA vertical really move the needle?
If they do, this is a stock that just grinds higher, supported by that dividend. If they stumble on credit again, if we find another one-off cockroach, it's dead money.
It is all about execution now.
So here's a final thought for you to chew on. We talked about them pausing M&A. But in a world where scale is everything, how long can a bank this size survive without buying or being bought? Is this organic growth strategy a permanent shift or just a pit stop before they put themselves up for sale?
That's the question for 2027.
Keep watching the spreads. Talk Tickers out.